Welcome back to Investing Talk Podcast.
Today we're looking at Apple.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. We're looking at a company that is, I think, fundamentally changing its financial identity. Our whole analysis today is really built around their latest numbers, fiscal Q4 2025, which ended back in September.
And the top line numbers, they looked really strong. I mean, another record for revenue and EPS, which sounds great. But if you dig a little deeper, the growth wasn't really uniform. It was really driven by two main things, services and Mac. The iPhone is still the core, of course, but its revenue just had, well, modest growth, up about 2% to around $46.8 billion, which is fine, but maybe less impressive given the headwinds we all heard about in China.
That 2% on the iPhone is almost a distraction, The real story, the structural shift, is all about services. This is probably the single most important factor for the company's valuation going forward. Services revenue hit a record of $28.8 billion in the quarter. Just an unbelievable number.
Wait, $28.8 billion in one quarter. That is massive.
It's huge, and that's a 15% jump year over year. I mean, if you annualize that, the services division alone is getting close to $110 billion.
That's bigger than most tech companies entirely.
Exactly.
Yeah.
But the size isn't even the whole story.
No, it's not. And that brings us to the key metric, the thing that really changes the entire thesis for Apple, the margins on that services segment. This is what you, as an investor, really need to focus on.
Absolutely right. Services carry segment gross margins of over 70%. So think about it this way. For every dollar they get from an iPhone, maybe they keep 40 cents of profit. But for every dollar from services like the App Store, iCloud, all of that, they keep over 70 cents.
So it's not just the fastest growing part of the business, it's structurally the biggest profit contributor. It's this massive ongoing tailwind for the entire company's margins. It's like a profit machine they've bolted onto their hardware.
And speaking of hardware, we do have to talk about the Mac. The performance there was stellar.
It really was.
Mac revenue grew year over year, which is really notable in what's been a tough PC market. This is a huge signal that their big long-term bet on in-house silicon is absolutely working. We're seeing the full effect of the M4 and M5 chip refresh in the new MacBook Pros.
And that custom silicon does two things perfectly. One, it gets existing users to upgrade from the old Intel chips. And two, these new machines are so good, it's driving up the average selling price, the ASP. People are paying more for them.
Right. Now, we should probably touch on the one softer spot, which was wearables, home, and accessories. That segment was down year over year. And it's probably a couple of things. Some post-pandemic normalization, people aren't buying as many extra gadgets, and also more competition.
So is that a weak spot to worry about?
I don't think so, not fundamentally. The revenue dipped, yeah, but it's still so important strategically. It's the glue. Every Apple Watch, every pair of AirPods, it just locks you deeper into that ecosystem. It raises your cost to switch.
Okay, so that's the rear view mirror. Let's pivot to the future, because the forward guide from management, that's where things got really interesting.
It was a massive positive surprise. Management guided for Q1 of FY26. They're calling for revenue growth of 10 to 12% year over year. That's way above what anyone was expecting.
And what's driving that?
They're expecting double-digit iPhone growth, driven by the new iPhone 17 cycle.
So you have higher revenue coming, but you combine that with the margin story we just talked about, and that's where you get this potentially explosive profit growth.
Correct. And the margin story confirms this whole thesis. The gross margin guidance for Q1 2026 was raised to a range of 47 to 48%.
Which is a huge jump. Historically, they've been in the low 40s. Hitting the high 40s is a total game changer.
And it's happening for three main reasons. First, that services mix, which has much higher profitability. Second, the efficiencies they're getting from their own silicon, and we're paying Intel. And third, just steady supply chain improvements.
And this all comes down to earnings power, what we call operating leverage. And for you, the listener, this isn't just a fancy term. It just means that their costs are growing slower than their revenue. So every new dollar of sales brings a much bigger chunk of profit to the bottom line.
That's exactly why we're seeing suggestions that EPS growth, profit growth, will outpace revenue growth for the next couple of years. Analysts are already rushing to revise their estimates upward because of this new margin guidance. It's driving everything right now.
So to sum up what Wall Street is now thinking, revenue growth will be steady, maybe mid to high single digits. But the kicker is they expect profit growth, the EPS, to be in the double digits for the next 3 years.
And that's the key figure, double-digit EPS growth.
Okay, so that's the financial engine. But that engine only works if the moat, their competitive advantage, holds up. How durable is it right now?
Oh, it's multi-layered and extremely durable. I think
Yeah.
some people still underestimate it. What really keeps you as a customer from switching, it's that tight integration of hardware, software, and services.
Yeah.
iCloud, iMessage, the App Store, the way you can just hand off a task from your iPhone to your Mac.
That friction is the moat. We all know someone who tried to switch to Android to save a few bucks and then came right back 6 months later because they missed being in the iMessage group chat.
Precisely. And the scale is just staggering. As of May 2025, the company had over 1 billion paid subscriptions. Not devices, paid subscriptions. That's a vast captive audience for whatever they want to sell next, especially AI.
And if you compare them to the competition, their custom silicon, the A-series and M-series chips, it's just a massive advantage.
It's all about that integration. They control the chip and the software, so they get incredible performance per watt. And you have to mention their reputation for security and privacy. That's a real selling point for a lot of people.
Okay, so speaking of differentiation, we have to talk about the really speculative part of this, but it's critical, the AI supercycle idea.
This is the big debate for the stock's future valuation. There's so much speculation around Apple Intelligence and deeper AI integration into the operating systems. And we're not just talking about, better voice commands.
So what are we talking about? What are the rumors?
The rumors point to new kinds of on-device AI that can enhance everything from search to photo editing, all running locally on the device, which, again, plays right back into that privacy angle.
And if those features are compelling enough?
They could drive the iPhone 17 upgrade cycle in a way we haven't seen since 5G was introduced.
Right.
It could totally re-rate how the market sees Apple less as a hardware maker and more as a secure consumer AI platform.
Let's shift to the foundation for all this. The balance sheet. It's a fortress.
Absolutely. Even after all the money they've returned to shareholders, they have a net cash position of around $34 billion as of September.
And that cash position is built on just insane cash generation. They generate over $100 billion in free cash flow a year. I mean, very few companies on the planet even generate half that.
And that FCF is the bedrock. It funds R&D, it funds expansion into places like India, and of course it funds those huge capital returns.
And those returns are significant. In 2025, they announced a $110 billion share buyback authorization. That's one of the largest in corporate history.
And they also bumped the dividend. But you should really focus on the buybacks. They aren't just cosmetic. They actually reduce the number of shares out there, which automatically pushes up the EPS. Your slice of the profit pie gets bigger.
And, just briefly, the technical picture seems to align with this. The charts look pretty constructive. You've got what they call a golden cross, where the 50-day moving average is above the 200-day.
Right, and that pattern often suggests that the big institutional money is seeing this fundamental shift and is building positions in the stock.
Okay, this all sounds overwhelmingly positive. So let's talk about the risks. Let's cover the bear case, starting with what's been in the headlines. Key talent leaving.
This is a legitimate concern. There are reports that their chip chief, Johnny Srucci, might be looking to leave, along with some other execs. And since the whole margin story relies on that custom silicon advantage, leadership continuity is vital.
So does the loss of one person mean the whole moat disappears?
Not necessarily, not in the near term. The mitigant here is that Apple has incredibly deep engineering benches. They have a history of managing these transitions. We're not seeing any near-term impact on their product plans.
The other big risk is geopolitical. We know about the headwinds in China, and there's always regulatory scrutiny around the App Store.
But they are actively working to mitigate that. They're diversifying manufacturing and growth into India and Vietnam. We're even hearing chatter about them working with other foundries, like Intel, to reduce supply risk.
So when you weigh it all, you have to acknowledge the valuation is high. But that combination of double-digit profit growth, massive cash flow, and the $110 billion buyback, it provides a pretty powerful buffer.
Absolutely. To sum up the bull thesis, Apple is successfully shifting from being a hardware company to being a high-margin, AI-enabled platform. The market might still be underappreciating how profitable they could become, especially with the high-margin services business and the upcoming AI-driven iPhone cycle.
Which suggests this stock is set up as a long, multi-year position, a 3 to 5 year hold. But there could also be some significant tactical upside over the next 1 or 2 earnings reports as the market fully absorbs this new, higher growth profile.
Thank you for joining us. If you found this analysis helpful, please remember to subscribe for more actionable investment analysis.